You're right.
All right.
I couldn't have visualized that unless you did this. This is good because I'm like, okay, how do you, but you are taking it from 100 units down to what, 65?
You have to, yeah,
Yeah.
because they're too small. They're hotel rooms. Our sizes are 369, so 300 and some change square feet for the studios, 600 for the 600 square feet for the one bedrooms, and then 900 for the two bedrooms. There's still a smidge on the smaller side. There's an army base here and a medical center that will be leaving a number of these furnished. So we think it will be just fine. It's real close to our comparable property in unit size. Here's a mock-up of what a studio would look like too. So you walk in the door, to the left is your bathroom, as almost always in hotels. It's either to the left or the right. In this case, it's to the left. On the other side of that bathroom, there's your kitchenette. We have used the plumbing from the bathroom for the kitchenette. Good thing with hotels, you have 100 beds, 100 desks, 100 chairs. We're kind of playing the furniture merry-go-round and what we're going to do with all of these furnishings as well. Some of them we will keep. Some of them will, keep and put other furnishings in there to gussy it up a little bit. But because of the population around there, and as I mentioned, the military base and people visiting the military staff there, as well as the medical center, there is a demand for 6-month leases on furnished rentals. So that bodes perfectly for us with the hotel and having all these furnishings. All right, here's the deal. The deal structure and exit plan. Remember, purchase price, 1.7 and some change. Renovation, 1.7 and 1.7. Renovation, we figured about 6 to 8 months. We'll have this financially stabilized by 18 months. We're offering an 8% preferred return on this, accrued. So distributions will be paid out at year 2 once the property starts making money. Cash out refi is our plan at year 2. We're on a bridge loan since this is, nobody's there. These are tricky to underwrite. There's no rent roll. There's no T12. There's no tenants. There's no nothing. So Fannie and Freddie said, no way, no nothing, no way to you guys.
You're way too risky for us.
Way too risky. So hello, bridge financing. So we're good on that for 24 months. At year 2, we'll be refinancing out into a Fannie small balance loan. The reason for Fannie is we can lay a supplemental loan on top of it for a second refi out. 70% of capital is returned at year 2. And the second cash out refi is at year 6, where the remaining 30% of capital will be returned. This is a legacy structure. So the experienced GP that's very good at heavy lifts right there in Arizona, they've done many, many such heavy lifts. They're looking at this saying, we don't really want to flip multifamily forever. We want a legacy, something that we can, continue to have cash flow, give investors their money back, but keep for another 5 years. So the plan is 8 to 10 year hold. If the market's great in 8 years, we sell it then. But all investor capital is returned at year 6. And then it's mailbox money from there.
Now, are the investors, even though they get their money back at year 6, are you giving the ability to stay in?
They're in. They're in the deal with us.
Wow. Okay. Very interesting.
Yeah, and you can do this with hotels. In running a multifamily with a small value play on a 5.5 cap rate or a 6 cap rate, equations like this don't work with 2 cash out refis and then to keep the deal. But there's so much money or so much meat on the bone on these hotels. You can run an equation like this.
Yeah, it makes sense. Yeah, you're not, yeah, exactly. Wow.
Yeah. So we're all in, guys, at about $4 million. This is CapEx, reserves, fees, contingencies. So we're at about 62,000 a unit. Expected sale price is about 5.8, which puts us about pretty close to 90,000 a unit. For the 10 years, they get the benefits of cash flow, the tax deduction. We're going to do a cost seg study on this, of course. And then there will be a distribution profit of about 1.7, we figure. Now, pitfalls, Mayday, what to consider with hotel conversions, and there's a lot. So brace yourself. Your deal will probably begin and end with zoning. Zoning is super expensive. We lucked out in this tertiary market in Arizona where multifamily and hotel were zoned the same. It was just an over-the-counter change of use. But zoning can be very expensive. We talked to another investor in Phoenix who has a hotel, is working on under contract. The city has made him finance $500,000, $500,000 to build a road.
Oh my goodness.
Yeah.
In front of the building?
In front of the building, a road to the building. The road wasn't sufficient, but they said, if you want your zoning changed, this is what you got to do. And we don't want to do it, but it needs it. So we'll have you do it.
Wow. I guess you don't have to go all the way to Washington to see the kind of the strong arming that goes on, huh?
That's right. Even in Arizona.
Oh my goodness. Now, with something like that, did he have it in the budget? Going back to what you talked about earlier, obviously, something like that is, for a traditional wouldn't work. Is that something he contemplated that, okay, if he doesn't do this, basically he's not going to get the deal, right?
Strangely enough, he knew. He had got into it far enough that he knew that they would come ask that. But I think he budgeted about 300. I don't think he budgeted $500,000. Fire safety is another major whammy to think about and budget for. Equally to zoning, I would say. I'd say these are your two biggest pitfalls. One of those is what I had explained before with the plumbing and the fire sprinklers that, plan almost $200,000 to run fire sprinklers through the whole building on a dedicated line. It cannot be on the same line as all the other water utilities. It must be its own dedicated line. Second on the fire safety is drywall. In hotels, the thickness of drywall is not as thick as it is in multifamily or as they require it to be for fire safety. So it's quite possible you'll have to go through each unit and yank out all the drywall and put in thicker drywall.
Oh, so that's when you're hearing your neighbor next door partying and stuff. It's not because the walls are thin, but they really are thin.
They really are thin. The drywall is a lot thinner than it is in a multifamily.
Didn't even realize that.
That explains a lot.
Yes.
We lucked out in this case because you don't know really till you get there and you bang a hole in the wall. So we said, okay, we've got the deal closed. Let's see what we've got. Banged a hole in the wall to find that it's all cinder block. Our Quality Inn motel here is essentially solid cinder block stone. So they said, forget about drywall. This thing's made of stone. You guys are good.
Oh, wow.
Yeah, that was a big cost savings. Something else to think about, franchise agreement buyout. A couple ways to go about this. You can either have the owner negotiate with the franchise. In this case, it was Choice Hotels that owns Quality Inn. I know of another investor that takes these properties subject to, and then from there, he goes in and negotiates with the franchise himself. You must buy out the franchise. The prices can range from $30,000 to $150,000. We lucked out on ours. We got out at about $33,000.
Now, is that what was left on the owner's contract? Is that basically what that means?
Yeah, that's a good question. I'm unsure how they gauge that, but that would be my guess. I would think that the franchise agreements are based on a timeline and they buy you out on the timeline remaining.
Gotcha.
Mhm. But some of it is just the brand you're dealing with, an expensive brand. If they want to gouge you on the franchise costs, it's whatever they signed up for, you know. Non-traditional financing, we know about that. Bridge lending, prepare yourself, brace yourself for bridge lenders. And I would say the last thing on this is have a comparable property. For us, we have a property 5 minutes away. On this project, we have a property manager managing 85% of the lift on this. And the reason is they did the exact same project 5 minutes away in Sierra Vista, Arizona. And they've brought it to market, and it's they completed it 6 months before ours. So they knew exactly what to do. They knew exactly what the rents were. They would just plug and play what they've already done. We have a proof of concept. If any of you listen to Michael Blanc's podcast, by the way, our comparable property was mentioned on that. It was his episode number 269. And at the very beginning, he gave me a shout out. I was pretty shocked, actually. I almost crashed my car in hearing it. But
what's your name on the radio? You haven't heard your
my name on Michael Blanc's millions of subscribers. I had no idea that was coming. But the subject of the podcast, he said, yeah, shout out to Becca Hintergart. She did a hotel, here in Arizona. And who they had on the show was Serge, who has a hotel property in Sierra Vista, Arizona, and that is our comparable.
Wow. Okay. Awesome.
I know. And he's putting it on the market, so we'll have a successful exit. This should go full cycle. So we'll have a very good vision of exactly what this will look like.
That's great. Now, did that make the team more comfortable to do something like this? Because obviously, most everybody on this call is multifamily, not in conversion. Did that help the team to see, okay, we can do this. We have a property manager there. He's already done this. Did that help the team morale?
Tremendously, because our experienced GP that we're working with, they've done 18 heavy lifts. I mean, properties that have been condemned.
Gotcha.
And they said, you know what? We'll let the property manager do it. They bid against them on pricing, and the property manager, they had the economies of scale and resources and supplies that they actually were getting things less expensive than we could. So it made everybody very comfortable. There are things that we're doing on our own based on the contacts that we have, like the pool. We have our own pool contractor, HVAC. We have their team we like to work with, the electrical as well. But a lot of these moving around doors, the door merry-go-round bit, and a lot of other things we're having the property manager do. So it's a really good mix.
That's wild.
All righty, folks. So I'll put my contact info in the chat. But I'd love to talk to you. Feel free to email me, shoot me an email, and I could send you my Calendly link. In fact, I'll put that in the chat as well for everybody. And as you see, I'm not a big shot, but I'm growing my portfolio, which is even better because I'm an open book and would love to talk to you and partner in any way on a co-GP, LP, whatever you have in mind.
You can't say you're not a big shot. You got a professional presentation, and you were mentioned on Michael LeBlanc's podcast. So I mean, come on. I mean, I'm just grateful you wanted to do it with us before you start charging fees.
You're too sweet. I'm an aspiring big shot.
There you go. Let the next guy pay it, right? Let the next guy pay it. Well, God, thank you very much. Goodness gracious. Well, let's do this. While you're putting that in there, does anybody have any questions? I know I've got a couple written down here. Anybody have any questions that they want to ask Becca? And let's start there. If you have one, just unmute yourself and then just go ahead and ask.
Yeah. Hi, Becca. Thank you for the inspiring and creative idea. I wanted to learn a little bit more about who are the key partners you have that's different from a regular multifamily team.
Sure. Well, we have been targeting experienced GP groups that have boots on the ground in the market we want to be in.
Mhm.
So we have had our eyes on this GP group for a while, developing relationships with them. And when they came across this deal, they said, okay, are you guys interested in partnering up?
Mhm.
So it's a team sport.
Okay. Understand. So like, were there any specific skills that you were looking for in the GP, in your, not just immediate GP team, maybe vendor team, to put this deal live? Because like some of the things, the zoning and things like that you're talking about, it's not like, not all the GPs or not all the vendors have those experiences. Seems like you almost had to go and formulate a slightly different team than what a typical team would be.
Yes, yeah. Much of that came from the property manager because they had just completed this 6 months prior and 5 minutes away. Then half of that, or maybe a quarter of the contacts were already ours with our experienced GP, with the electrical, with the pool. And so, yeah, it was some existing contacts,
Okay.
some new ones. But yeah, these are heavy lifts. You really need to either find someone who has done these, that has their own team, or develop your own team, knowing that there's a lot of boxes to check. It's a lot. There's a lot of boxes to check, but there's so much more meat on the bone in these deals. You know, I'm out there fighting it out for 6% cap rates 3 states away. And, you know, I thought, what am I doing here? Why don't I buy something for 1/3 of the price, 1/4 of the price, and just bring it up to speed, especially during now these opportunities are available
Got it.
in this
Thank you.
hotel apocalypse. Yeah.
Yeah,
My
it
pleasure.
is.
Thanks for the question.
Thank you.
Anybody else have a question?
Oh, here's some questions in the notes. Do you want to read them out, Pat?
I have a question, Becca. With that rehab timeline, the 6 to 8 months, did they incorporate any additional time in there for any delays?
Yeah, we're estimating really on the 12-month time frame. I put 6 to 8 months because that's what we realistically think it is. For the most part, we're telling the investors about 12 months because heavy lifts, you never know what can go wrong.
Yeah. Cool.
What will go wrong?
Local? Yeah, true. Out here, yes, for sure.
Oh, yeah.
Is your property manager local on site?
This is Shelton, Alicia. So they're in Arizona and Texas. Huge company. Yeah.
Cool. Thank you.
Yeah, my pleasure. Nice to see you.
Nice to see you too.
Becca, this is Harry here. Yeah. Thank you for the wonderful presentation. That was great, actually. Quick question about the zoning. So are you changing from commercial to residential?
You are changing from hotel to multifamily.
Hotel to multifamily. So that means you're moving to more stringent zoning, correct?
One would say, based on the renovations that they've put us through with fire safety, I would say yes. Either way, it's, yeah, I would say yeah, because, you need thicker drywall, you need all the fire sprinklers. Yes, I would say it's more stringent.
It's more stringent, so you're changing the property use as well. So how it would impact on your taxes, because is your mill rate changes, like what was the taxes before and what's the taxes afterwards?
That's something to think about in your own market. For us, it was already zoned what we needed. And so we had the tax rate. Not a lot was going to change there. For us, it was just an over-the-counter change of use permit. So
Okay.
if you want to check your zoning, I mean, if also this is a tertiary market, so that was a little easier too. And so as we know, when you get into Phoenix, it wasn't as easy. Yeah, zoning, Harry, is it's a whole ball of something to look at there. There's zoning consultants also that many people hire in hotel conversions because it is so convoluted.
So that was a mid-rise building, just two stories, I believe,
Two
so
stories.
stay away from big hotels because then maybe your elevator, the shafts are not, it would be major expense as well, right? For
It
the
might
big
be.
hotel. Yeah. Okay.
Yeah. The company I mentioned that does it in Austin, New NU, they convert large hotels into, the schwanky studios for millennials. So that would be one to look at and see how they would do it. But yeah, I think there'd be a greater complications in a high-rise hotel
Right.
based on what they're making us go through for a little mid-rise in a tertiary market.
Becca, this is Jim. I've got tons and tons of questions, but I'll try to keep it to just a few and let everyone else have a chance. Regarding the capital stack and the capital raise, obviously it was a bridge loan. Could you speak to the ease or difficulty of getting the bridge loan? What kind of rates to be expected for this asset? Because I'm sure that it's, this is still a relatively new idea and not very many lenders lending in this space. So was the capital expensive? And the second part of the question is, was the entire capital raise, the 1.7, a traditional capital raise, or did you have a more sophisticated capital stack? And if it was traditional, what did it take you longer and more convincing of the investors? Because I know my investor base is, pretty much a Texas yield investor. And so when you come to them with anything other than that, you're fighting an uphill battle. So if you could, those two questions are burning on my mind.
You bet, Jim. Love to. Nice to see you.
You too, Becca.
Right. So first off, the capital stack, we did a bridge loan. The company was Ignite. Along with the door merry-go-round, it was a little bit of a bridge lender merry-go-round. We looked at Pender, who I guess had some challenges. We looked at CalCap, and we looked at a couple others. Ignite came through and funded 85% loan to cost. It's not cheap. Buckle up. It's in the 9%, but such is the world of bridge lending, painful. The objective is to get out of these loans as fast as you can. In respect to the raise, this was a very difficult raise. I mean, very difficult. I realize all of my friends and family and investors, they're multifamily investors, and this is new. It's in a tertiary market. It was, there's just so much going on. A legacy plan of 10 years. There was just so much going on. A confused mind said no. So we really struggled with this raise. An interesting thing that Bakerson's the GP, you guys probably, I know you know him, Jim, but they had Ruben Greth there on his podcast for the Capital Raisers show, which is such a value. So the game plan here was, they said, okay, first let's do a 506B. Let's swoop up all the unaccredited, the family and friends. So we gathered everybody we could there, got our 506B. At the point that we couldn't bring any more people for that, they closed the offering, the 506B, and opened up a 506C. From that point, Ruben could get on his podcast and stand on the rooftops. And then we reeled in the accredited investors. So that's the first I've heard of a GP doing it that way. I thought it was very clever, brilliant, really, and especially if you have someone with the platform on your team. It's a great way to do it.
Yeah, and important to note that you can do it that way, but you can't do it the other way. If you try to go
Can't do it the other way.
right, if you try to go C to B, there's a cooling off period, which would add to the timeline of trying to get closed. So, but
Exactly. Yeah.
yeah.
Yeah. Once you go on the rooftops, you can't get off the rooftops, right? It's already out there.
So that, let me dovetail on that question. So is there any period, Jim or Becca, from the B to C that you have to wait? I guess there's a formal document that closes that, and then now your attorney signs something, and then that next day you can go 50cc or 506c, right?
Yeah. Minimal. It was a day or two, I think.
Wow, that's interesting.
Yeah.
I never knew that. That's big.
That's huge. That's huge, especially for anybody who's, thinking of or has a platform or building a platform. This is a really good strategy. And it worked.
Yeah, because one of the questions in there was how difficult was the funding. So it sounds like it was really difficult because you had to convince people.
Oh, it's very difficult. Very difficult. I really wouldn't recommend this for maybe a first raise for someone.
Even though it's 1.7, which in today's world is a small rate, but
Tiny.
when it comes to trying to convince, to your point, Becca, a confused mind, there's no such thing as a small raise, and it's going to be very, very difficult. The other thing to note, and I'll ask you because I've actually exercised the same strategy once before. How much were your legal costs? And did you know going in you were going to exercise the strategy and negotiated a fixed cost, or did you exercise the B and then have to come back in and double up on the legal cost?
Well, the GP has done these so many times. I think it's just template. I think it's just, 15 grand for the B, then another 15 grand for the C.
Yeah.
Yeah. A lot of it's boilerplate.
Yeah.
Mm-hmm.
And that tracks with the same prices I had to pay. So you pretty much double up on your prices. Again, as long as it's underwritten and you have that in your underwriting for the deal, then it doesn't matter. So
It doesn't matter as long as it's in there. Oh, another thing you can do is, I failed to mention this, you could do crowdfunding for hotels. And if you go to some of these websites, as long as you have a 506c, you can go stand on the rooftops, and on some of the websites, crowdfunding.com, Fundrise was a big one. You'll see several hotels there that are funded within 24 hours.
yeah, and the only cautionary thing I'll say, if you're planning on doing this and you haven't done it before, a lot of those platforms will not let new investors, new sponsors on the platform. So
Really?
the fact that Becca has already done it, she would find it easier to get on the platform. But they kind of want proof of concept. But if you have a very experienced sponsor with you, like Bakerson, then I don't know if you guys did choose to do that, but she probably could have gotten on. But
Yeah.
It's not a fast process either. You can't get into your capital raise, have 45 days to raise your capital, find out you're in trouble at the 20th day, and now think that you're going to jump on the crowdfunding site, because they will have an onboarding process that'll take anywhere from 2 months to 6 months.
That's exactly right. And that's what we experienced when we started to go, whoa, what else should we do here? We went on the crowdfunding sites, and they took a long time, 45 to 60 days. By the way, if any of you are interested in that, we've done quite a bit of research on it. So I have, I don't know if you ever want to go the crowdfunding direction, but we researched all the companies for that and the corresponding costs.
Oh, wow. Cool.
Yeah, so there's
Would
my,
love to, if you want to speak on that as another topic, would love to get you on some other, I don't know if Pat wants to have you back, or if not, we'll put you on another GOB meetup.
Goodness
Would love
gracious.
to talk about that.
Yes, definitely. That would be good. There's one question that came in the chat. Of course, now I lost it.
Go ahead, baby.
Go ahead.